Stop scrolling for a second, because what happened overnight in silver is the kind of move that looks normal on a chart, right up until the day it isn't. We just watched silver sprint toward that three-digit wall, the one number everyone whispers about, the one number that turns calm markets into chaos. And right as it got close, the market did what it always does when somebody is trapped on the wrong side of the trade. It slammed the brakes. Hard. If you're holding silver, thinking about buying silver, or even just trying to understand why the same metal can feel boring for years and then turn into a headline machine in weeks, this is the video you needed today. Because I'm going to walk you through what that sudden overnight hit likely signals, what the quiet indicators underneath price are screaming, why the $100 level matters way more than a round number on a screen, and what I'm watching next that could either trigger a brutal shakeout or set up the next leg higher. And then, near the end, I'll explain the one mistake that wipes people out in silver bull markets, even when they're right, and how the biggest players use that mistake like a vacuum to scoop up metal while everyone else panics. Now, before we jump in, quick favor. My channel stats are loud and clear. A huge chunk of you who watch these videos regularly still haven't subscribed. And look, I get it. You can watch without subscribing. But if you're getting even a little value from this breakdown, help me out by hitting subscribe. We're pushing hard for 50,000 subscribers in the next 30 days, and your click actually matters more than you think. Also, we're now posting members-exclusive videos on a regular basis, and this isn't recycled content. A dedicated team is working behind the scenes to build these deep dive updates only for you, our special members and the John AG family. If you want in, click the join button right now, or use the link in the description. All right, let's get into it. Last night wasn't just volatility, it was a message. Silver pushed up toward the psychological line in the sand, and suddenly a burst of selling hit the market in a way that didn't feel like normal profit-taking. It felt like a defensive maneuver, like somebody needed that price to back away from the edge. And here's the part most people miss. When silver gets smacked like that at an important level, you can't just look at the price drop. You have to look at what happened at the same time. Because while price was getting hit, the cost to borrow physical metal, the lease rate, spiked. That's a weird combo. If the market was truly well supplied, if sellers were calm and metal was plentiful, you don't usually see borrowing costs jump at the exact moment paper selling shows up. A normal, comfortable market has lease rates sitting low, almost sleepy, fractions of a percent, background noise. But when lease rates jump, when they jump hard, it's the market whispering, physical is tight. Think about that. Paper says sell. The physical borrowing market says pay up. Those are two different realities colliding. And that collision is where the real story lives. Now, could silver still pull back next week? Absolutely. In fact, I'd be surprised if we don't see at least one scary dip along the way. Silver doesn't move in clean stair steps. It moves like a staircase built by a lightning storm. But the key question isn't, can it dip? The key question is, what kind of dip is it? Because there's a dip that resets leverage, and there's a dip that signals the trend is dead. And if you don't know the difference, silver will teach you the lesson the expensive way. So let's talk about the machinery under the hood and why technical patterns, yes, even the ones that usually work, can start lying to you when a market gets dominated by a small set of heavy players. For years, one of the strangest features of the silver market has been concentration. Not a lot of traders, not a liquid market, concentration. A small group of large institutions has, for a long time, carried a short position that is unusually large compared to most other commodities. I'm not saying that to be dramatic. I'm saying it because concentration changes everything. In a normal commodity market, price discovery is messy but broadly distributed. Lots of participants, lots of motives, lots of independent pressure. In a concentrated market, price can still move, but it moves through narrower channels of control. And that means the chart can look clean while the positioning underneath it is anything but. So when you hear someone say, the pattern says silver should do X, you have to ask, is the pattern working in a free market or a managed one? Because those are not the same game. Now, why would anyone bother concentrating shorts in silver at all? That's the question that always gets brushed aside with a shrug. It's hedging. It's normal. It's just finance. But silver is not just another industrial metal, and it's not just a shiny rock for collectors. Silver sits in a strange intersection of money, industry, and strategy. On the industrial side, silver is everywhere. Electronics, solar, medical, high-end manufacturing. It's a small component in a lot of systems, which makes it invisible until you try to replace it and realize you can't. And then there's the part that makes people uncomfortable to talk about, defense demand. High-performance systems don't choose materials based on vibes. They choose them based on properties, conductivity, thermal stability, reliability under stress. When the environment gets extreme, you reach for the material that works, not the one that's cheap. That's why silver shows up in places the average investor never sees. Now, I'm not here to turn this into a conspiracy show. I'm here to explain incentives, because incentives shape markets. If silver is strategically important to critical systems, you can immediately see why there would be a preference for stable, contained prices rather than chaotic spikes. And when you combine that with a paper market that can expand and contract supply on a screen far faster than physical supply can move in the real world, you get a setup that can last until it can't. And that brings us to the part of the story that matters right now: delivery stress. Because paper games are fine as long as nobody asks for the thing the paper represents. The moment too many players say, "No thanks, I want the metal," the whole structure changes. And lately, we've been seeing signs that more participants are choosing delivery, even in months where historically delivery demand is quieter. That matters. It matters because it's not a tweet. It's not a headline. It's behavior. When you see a lot of contracts standing for delivery, you're looking at real capital saying, "I don't trust paper settlement. I trust metal in hand." And when that behavior expands, it becomes a stress test. Now, one of the cleanest stress indicators is something most people never learn until they've been burned: market structure. Specifically, the relationship between spot and futures. In a comfortable market, futures trade above spot. That's normal. You're paying for time, storage, insurance, and the simple fact that money has a cost. When that flips, when spot starts trading above futures, you're seeing a market that's willing to pay more to have the metal now than later. That's not normal. That's urgency. That's distrust. That's the market saying promises later aren't good enough. And when that shows up in precious metals, it tends to show up before the public narrative catches up. Now let's connect this to the $100 level. People treat $100 like magic because it's round. But the real reason it matters is psychological and structural at the same time. Psychological because traders anchor to it. Stops get placed around it. Headlines get written around it. Retail piles in around it. It becomes a stage. Structural, because if there are big short positions that were comfortable at $70, nervous at $85, and sweating at $95, that extra push toward $100 can turn discomfort into emergency. And emergency trades look different. Emergency trades don't wait for good prices. They just need the price to move away from the danger zone. That's why you can see a sudden dump of contracts at odd hours. That's why you can see a hit that looks irrational unless you remember. Somebody might not be trading for profit. Somebody might be trading for survival. Now here's a detail that should stop you in your tracks. While Western pricing gets slapped down, the premium in key Eastern markets has remained elevated. We're talking a persistent premium, several dollars an ounce, where physical is valued higher than paper implies. That creates a simple, brutal mechanism. If you can buy exposure cheaply in one place and turn it into physical value in another, you've created an arbitrage vacuum. Every dip becomes an opportunity for metal to move east, and once it moves, it doesn't casually wander back. So when you see a price smash and you think, "Oh no, silver is weak," pause and ask, did the physical premium collapse too? Because if the premium stays high while paper price gets hit, the dip may be less about weakness and more about transfer. Transfer from leveraged hands to unleveraged hands. Transfer from paper to physical. Transfer from west to east. And that is not bearish. That is a structural drain. Now, I want to be careful here. None of this means silver can't drop. It can. Silver can drop in a bull market the same way a lion can stumble while running. It doesn't stop being a lion. In fact, silver bull markets are famous for terrifying pullbacks. So I'm going to say something that sounds contradictory, but it's the truth. Short-term caution and long-term bullishness can coexist. If you're trading short time frames, you respect volatility. If you're stacking for the long term, you respect fundamentals and you manage your emotions. If you mix those two modes without realizing it, you get wrecked. And that's why the next part matters: margin. Because margin is the silent killer in silver. Here's how the trap works. When silver starts moving, the leverage looks tempting. A small amount of money controls a large amount of metal exposure. Everyone feels smart. Everyone feels early. Everyone feels like a genius. Then the exchange raises margin requirements. Suddenly, the same position needs more cash behind it. And if you don't have the cash, you don't get to hold through the dip. You get forced to sell into the dip. That selling pushes price down, which triggers more margin stress, which forces more selling. It becomes a cascade. And that cascade is exactly what big, cash-rich players love, because they can step in and buy when you're not selling by choice, you're selling by force. This is what people mean when they say, shaking the tree. It's not poetic, it's mechanical. And the cruel part is, the shakeout doesn't require the fundamentals to change at all. No new metal needs to appear, no demand needs to vanish. All that has to happen is that enough leverage players get pressured at the same time. So when you hear, they raise margin after a big move, understand what that really means. It means the rules changed overnight in a way that targets leverage. Now, imagine you're the leverage trader. You're holding multiple contracts. You were fine yesterday, and today you get told, post more cash or reduce exposure. That's not a market opinion. That's an ultimatum. And it's why silver drops can feel like cliffs. But here's the twist. Those cliffs often end the moment the forced sellers are cleared out. And what happens next is the part nobody expects in real time. Once the weak hands are flushed, the price snaps back. Not because of a magical pattern, because the buyers with serious capital were waiting, patiently, for the forced liquidation to do their job. That's why you can see a sharp move down followed by an aggressive recovery. It's not random. It's redistribution. Now, let me paint a specific scenario, because this is where the story gets spicy. Imagine you're a large short seller, and you've lived for years inside a comfortable range. Every time silver runs, you lean on it. You sell paper, you trigger stops, you wait for momentum traders to get bored, and you buy it back lower. Rinse, repeat. That strategy feels like gravity until the day the floor disappears. What makes the floor disappear isn't a chart pattern. It's a change in who is buying and why they are buying. When the buyer is a leveraged speculator, you can scare them. Push price down, raise margin, and they're gone. But when the buyer is a manufacturer who needs the metal for production, or a sovereign entity building strategic inventory, fear doesn't work. They don't care about your candle. They care about securing supply. That's why the East-West premium matters so much. If a physical hub keeps paying up even when Western paper price gets slapped, that's the market voting with money. It's saying, we'll take it, send it here. And if you want a simple way to think about it, picture a sponge. Every time the paper market dumps silver to scare people, the sponge absorbs it. The sponge is physical demand that doesn't flinch. Now, here's the cliffhanger hiding in that sponge. If the sponge keeps absorbing, the paper market can still paint whatever price it wants, but only as long as it can source metal when someone demands delivery. That's the tightrope. And this is where the failure to deliver line becomes more than a dramatic phrase. It becomes the moment the market stops being a price story and starts being a plumbing story. Because if deliveries keep rising while available inventories don't, you get a squeeze that isn't driven by hype. It's driven by obligations. That's also why we keep hearing over and over that certain banks have changed their stance or flipped positions. In plain English, it means some players are no longer comfortable being short, and they'd rather be on the long side than be the last one holding the bag. And when big players change sides, it's rarely because they suddenly discovered a new love for silver. It's because the risk profile changed. It's because the exit started to look narrow. Now, there was also chatter about a large Canadian bank putting out messaging that basically screamed, "This is the top, dump your silver," right before it got squeezed hard enough that it had to back off. Whether you buy that story or not, the pattern is familiar. When institutions publicly talk down a market, you should always ask who benefits if you believe them. If you're holding the metal and you sell in fear, you hand your position to someone who wants it. That's why these pullbacks are so emotional. They hit you right where your certainty lives. Now let's talk about the elephant behind the curtain. Paper versus physical vehicles. A lot of people are exposed to silver through funds and products that track price. And those products can be useful, but they introduce counterparty layers. Who holds the bars? Who verifies the bars? Who can audit the bars? Those questions matter more in a trust event than in a normal market. And if you've ever seen a situation where a major bank was fined for manipulation practices, spoofing, layering, call it whatever you want, the important part isn't the label. The important part is the precedent. Behavior happened, and it was large enough to be punished. And yet, the system kept running. So the practical takeaway is not be paranoid, it's be aware. Be aware that price can be pushed short term. Be aware that vehicles can add layers. Be aware that when the crowd panics, the best assets get transferred to the calmest hands. Now, here's where it gets interesting for your positioning. If silver is in a phase where physical flows are draining inventory from one region to another, then the paper price dips can be opportunities, but only if you can stay solvent and calm. That's the whole game. And this is why I keep saying, don't fight silver with leverage unless you're a professional who can handle rule changes. Because the exchange can raise margin again. Headlines can hit again. The market can drop $10 in a weekend and then rip $12 in the next 2 sessions like nothing happened. That whip is not an accident. It's the price of admission. Now, one more micro signal to watch is borrowing stress around key moments. When you see price get hit while borrowing costs spike, it's a tell. It suggests the selling is paper heavy while the physical side is still tight. And if that keeps happening as we approach the big number, you start building a roadmap. Roadmap says dips are likely, shakeouts are likely, and volatility is guaranteed. But if the physical side keeps screaming, the higher time frame trend is still alive. And that brings us back to the beginning. The $100 level is not a destination. It's a checkpoint. The market will test it. It will fake you out. It will try to make you quit. And then, when you're tired, it will do something violent. The only question is, are you watching the screen or are you watching the structure? Because the structure is where the next surprise is hiding. And that surprise can arrive without warning. Now, let me ask you a question, and I want you to answer it in the comments. When you see silver drop $10 in a week, do you immediately think top or do you think setup? Because your instinct here matters more than your analysis. And here's another question. If silver tags $100, what do you think happens first? Does it explode higher or does it fake everyone out with a brutal pullback? Drop your guess below. I read the comments and I want to see how you're thinking. Also, quick friendly request. If you're one of the people in this audience who has done well, maybe you built a position early, maybe you made a smart trade, maybe you turned a small stake into something meaningful, share your success story in the comments. Even a short note helps motivate others who are still building. Now, I promised you cliffhangers, so here's one. If the silver market is really tightening, and if delivery stress is really building, then there's one event that changes everything. It's not a headline. It's not a price print. It's a failure to deliver. Because the day a participant can't get metal when it's supposed to be delivered, the conversation changes instantly. That's when systemic risk stops being a theory and becomes a problem everyone has to price. Now, I'm not saying that happens tomorrow. I'm saying that's the line. And if you're paying attention, you don't wait for the day it happens to learn the rules. You learn the rules now. Because when the crowd realizes what's happening, the crowd pays more. Now, another important piece in this story is trust. Markets run on trust. Futures are a trust system. ETFs are a trust system. Even your broker is a trust system. And when trust erodes, behavior changes. People start demanding physical. People start paying premiums. People stop caring about paper liquidity. And that's when the market structure starts doing weird things that don't fit the textbook. So when someone asks, how are investors pricing trust right now? The answer is, they're pricing it through urgency. They're pricing it through delivery. They're pricing it through backwardation. They're pricing it through lease rates. They're pricing it through the willingness to pay more now than later. Now, let's talk about the everyday holder, because this is where the narrative usually gets it wrong. A lot of commentators assume that if markets crash, people will run to sell their metals at pawn shops. They assume panic equals selling. But in real crises, panic often equals hoarding. In a serious market scare, something bigger than a one-day wobble, people don't usually rush to sell the thing they trust most. They tighten their grip. And here's why. When you're scared about banks, you don't sell the asset outside the banking system. When you're scared about liquidity, you don't sell the asset that is liquid everywhere. When you're scared about counterparty risk, you don't sell the asset with no counterparty. So while paper traders may dump positions, physical holders often do the opposite. That divergence between paper behavior and physical behavior is exactly why silver can feel schizophrenic in bull markets. And it's why you need to decide which game you're playing. Now, I want to insert something quickly because it helps a lot of you. If you want more silver-related success stories, real stories of how people positioned, what they did, what mistakes they made, and how they actually made money, there's a link in the description to a second channel focused on those kinds of wins. If you're into that, subscribe there too and binge a few stories. You'll learn faster from other people's moves than from theory. Okay, back to the plot. One of the most telling signals recently has been the size of delivery activity even in periods when delivery is normally quieter. That's unusual, because it suggests the buyer is not a casual speculator. It suggests someone with serious intent, and serious intent usually comes with serious money. When billions move quietly, the news doesn't always notice it first. It takes time for the story to become a story, but the market feels it. And when the market feels it, it starts charging more for immediacy and charging more for borrowing. That's why lease rates matter so much. A jump from nearly nothing to meaningfully expensive is the market's way of saying, this isn't easy anymore. And when you layer that on top of repeated paper hits near big psychological levels, you get a picture of strain. Strain doesn't guarantee a break, but strain is not comfort. Now, let's address the elephant in the room. People will say, if silver is so tight, why can the price be smashed? Because price in a paper market is not always a direct report of physical availability. Paper can create temporary supply illusions. You can sell a contract faster than you can move a bar. You can hit the screen at 2 a.m. with the click of a mouse. You can't do that with a warehouse. So paper can push price around in the short term. But paper can't print physical indefinitely without consequences. If enough buyers demand physical settlement, the gap between paper price and physical reality becomes harder to manage. And that's when we see the secondary signals light up. Premiums, lease rates, delivery volume, structure flips. Those are the signals that don't care about your favorite candlestick pattern. Now, this is where I want to give you something practical. If you're watching silver and you want to avoid getting emotionally whipped, pick 3 indicators that you will track consistently. 1. The spread between spot and futures. Are we in normal structure or is urgency showing up? 2. Lease rates. Are they calm or are they screaming? 3. Physical premiums in major hubs. Are they collapsing or staying elevated? When all 3 line up, the story gets clearer. When price drops but these indicators stay tight, the dip is often leverage, not collapse. When price drops and these indicators relax, then you consider the possibility that demand cooled. That's how you avoid getting fooled by the screen. Now, let's talk about the whole suppression conversation in a way that's useful. The point is not to yell manipulation and feel righteous. The point is to understand that if large players have historically had incentives to manage price, then technical analysis alone may not capture the true risk, especially around key levels. A market can be suppressed for a long time, and then one day, it isn't. And the moment it isn't, the move can be violent. That's why people who think silver is boring get shocked when it wakes up. And it's why people who think it has to crash now get shocked when it refuses to. Now, there's another uncomfortable reality. When big institutions get caught manipulating markets, they often pay fines. Fines are not the same as reform. A fine can be a receipt, a cost of business. So the existence of penalties in the past doesn't guarantee the behavior disappears. It just tells you the incentives were strong enough that someone paid to keep playing. And if the custodianship of major investment vehicles overlaps with the same ecosystem of big finance, then trust becomes a central issue again. Which brings us back to the theme. Trust is everything. So, what do we do with all this? First, don't confuse price smash with thesis broken. Second, don't confuse bullish thesis with straight line up. Third, don't use leverage in a market where the rules can change overnight. Now, I know some of you are thinking, okay, John A.G., but what should I do right now? I'm not giving you financial advice. I'm giving you a framework. If you're a trader, you respect volatility and risk. If you're a long-term holder, you accept the pullbacks a part of the ride, and you plan your purchases accordingly. And if you're somewhere in between, you need to decide who you are before the market decides for you, because the market will force you to pick a side at the worst possible moment. Now, I want to bring in another point that gets overlooked. When the exchange raises margin, it's framed as risk management. And yes, exchanges do manage risk. But in practice, margin hikes have a very specific effect. They pressure the long side first, because longs are often more leveraged in momentum phases. That doesn't mean every margin hike is evil. It means you should understand the impact. Impact matters more than intent. So, if you see margin hikes into a rally, expect turbulence. Expect forced selling. Expect headlines about silver collapse. And then watch what happens next. Because the real move often starts after the headlines declare it's over. Now, let's zoom out. If global demand for physical continues to grow, and if industrial usage remains sticky, and if the monetary environment continues to look unstable, then silver has a tailwind that goes beyond any 1 week's chart. But silver doesn't give you easy wins. It gives you tests. And the test is always the same. Can you hold conviction without becoming reckless? Can you stay engaged without getting shaken out? Can you take profits without abandoning the thesis? Because the smartest move in a metal bull market is often not all in or all out. It's strategy. It's scaling. It's keeping a core position and managing the rest. Now, I'm going to say something that sounds simple, but it's the most important part of the whole discussion. If the biggest money in the world believes silver is indispensable, they won't care about a $5 dip. They'll use it. They don't use margin. They don't get the phone call. They don't get forced out. They buy when the rules squeeze everyone else. That's the game. And if you want to survive it, you stop trying to outtrade the biggest players on their time frame. You build a plan that doesn't require perfect timing. Now, one more cliffhanger. If we keep seeing persistent physical premiums and elevated lease rates while paper markets try to cap price near psychological levels, the next time silver approaches that line, the defense may get even more aggressive. The question is, does the defense still work? Or does the market finally say, enough, and push through anyway? Because the higher you go, the more pressure builds. And the more pressure builds, the more dangerous it becomes to be short. Now let's bring this back to you. If you're watching this and you've been stacking quietly for years, you're not crazy for feeling like the world suddenly noticed what you already knew. And if you're new and you're feeling the urge to chase, breathe. You don't need to chase. You need to learn how this market hunts. It hunts leverage. It hunts impatience. It hunts certainty. When everyone says it's guaranteed, the market punishes arrogance. When everyone says it's dead, the market punishes despair. So keep your head. Now, remember what I said earlier. Check the description after you finish this. You've got bonus links there, including the premium WhatsApp channel and the membership option. And I want to highlight something about membership. We offer members-only videos too. There's a separate team working on those, and they go deeper with extra research, extra data, and more careful scenario building. Those videos are only for premium members, so if you want the deeper layer, the membership link is in the description. And again, if you've been getting value here, please subscribe. Most of the people watching aren't subscribed, and we're aiming for 50,000 subscribers in the next 30 days. Help me prove the analytics wrong. Now, let's close with a reality check that can save you money. Silver can have air pockets. It can drop fast. It can scare you. It can make you question yourself. But a violent pullback in a tight physical environment is not automatically bearish. Sometimes it's the market clearing the runway. Sometimes it's the last shake before the next push. Sometimes it's the moment that creates the best entry for the people who stayed calm. So watch the signals. Watch lease rates. Watch premiums. Watch structure. And most importantly, watch your own behavior. Because the silver market doesn't just test your portfolio, it tests your psychology. And if you can stay disciplined through the noise, you put yourself in the tiny group that doesn't get shaken out right before the move everyone will talk about later. All right, I want to hear from you. Do you think silver hits $100 in the next major leg? Or do you think we get one more brutal fake out first? And if you've had any success in metals, big or small, share it in the comments. Let's build a wall of proof that patience can pay off. I'll see you in the next one.